Okay, let's dive into this explainer. Today, we're taking a highly analytical look at the underlying mechanics of heavy highway vehicle excise taxes. We're going to strip away all that dense bureaucratic jargon and get right down to the core logic of how these tax frameworks actually operate in the real world. Treating the data as an anonymous expert report, we're going to uncover the implicit assumptions and those totally non-obvious details that so often trip up logistics professionals. Now, unlike standard income taxes, the ones that take a retrospective cut of your end-of-year profits, the U.S. heavy vehicle use tax, formally executed via Form 2290, is a completely different beast. It is uniquely punitive. It operates as an uncompromising, forward-looking gatekeeper to public infrastructure. And if you're not compliant, it results in an immediate, hard stop to your physical operations. To really understand this, we're going to systematically deconstruct the tax ecosystem across 6 key areas: tax mechanics and scope, the weight calculation formula, strategic filing timelines, suspensions versus total exemptions, entity identity, and finally, proof of payment compliance. We're keeping our focus strictly on actionable strategy here, not just surface-level admin. So let's start right at the beginning with our first section, tax mechanics and scope, and how we actually define the trigger for this tax. The absolute crucial point here is understanding exactly what flips the switch on this liability. It applies exclusively to self-propelled highway vehicles over a specific weight threshold of 55,000 pounds. That means it entirely excludes equipment strictly used off-road. For instance, think of a massive piece of construction equipment. If it's only ever transported from job site to job site on a trailer and never actually propels itself down a public road, it fundamentally falls completely outside this scope. And it's really important to explicitly note that trailing equipment is not taxed on its own. It's solely the power unit, the actual truck itself, that triggers the regulatory threshold based on its combined pulling capacity. So remember that dual trigger. It must be self-propelled and it must be used on public highways. I love this quote because it brilliantly illustrates the core philosophy of the whole system. Expert analyses note that this tax is entirely proactive. You should think of it functionally as an upfront payment for the year ahead, rather than some retrospective fee based on your past mileage. This is executed formally through IRS Form 2290, and the federal tax year for this specific liability runs rigidly from July 1st to June 30th of the following year. So you're essentially prepaying for your operational rate to deploy heavy, self-propelled assets on public infrastructure long before a single tire ever touches the pavement. Moving on to Section 2, let's look at the weight calculation formula and dismantle a major operational assumption. Look at the stark contrast on this slide between the manufacturer gross vehicle weight and the taxable gross weight. This is a massive trap for fleet managers. That manufacturer's door sticker rating, the gross vehicle weight rating assigned at the factory, is completely irrelevant in this context. You absolutely cannot rely on it for federal tax compliance. Why? Because the liability is strictly based on a legally defined, completely independent metric called the taxable gross weight. Compliance reports reveal a very strict 3-step formulation to determine this exact taxable weight. First, you take the actual empty weight of the vehicle fully equipped for service. Then, you add the empty weight of any trailers customarily used with it. Finally, you add the maximum load typically carried by that specific combination. Let me clarify that second point about what customarily used actually means in a legal sense. If your truck pulls heavy flatbeds, say 90% of the time, the flatbed's empty weight is what counts in this equation, even if it occasionally pulls a much lighter utility trailer. And here is a wild, often overlooked detail. The formula specifically mandates including the weight of a full tank of fuel. That implicit assumption, the sheer physical weight of 100+ gallons of diesel, can easily, and I mean easily, push a borderline vehicle over that 55,000-pound threshold, or bump it into a higher tax bracket entirely without anyone in the back office even realizing it. This hierarchy is just vital to grasp because federal and state metrics frequently collide in the real world. If your calculated taxable weight is higher than your state-declared registration weight, or vice versa, the highest metric strictly dictates your federal tax liability. The authorities are not going to give you the benefit of the doubt here. They will simply look at both of those numbers and enforce compliance based on whichever one represents the heavier, more costly bracket. The House always wins on this one. Let's move to Section 3, Strategic Filing Timelines. We need to look at the cause and effect here. There is a non-standard timeline at play here that catches so many logistics managers totally off guard. The cause and effect is absolute. Deploying a vehicle onto public roads in any given month, let's just call it month X, triggers a rigid, prorated filing deadline by the final day of the very next month, month Y. This is completely independent of your state registration renewal dates. So to give you a concrete example, if you purchase a truck and deploy it onto the highway in August, your Form 2290 filing for that partial year is strictly due by September 30th. It operates on this unyielding next month end mechanism. Whatever your state renewals are doing has absolutely zero bearing on this federal deadline. And this boldly highlights the sheer financial danger of administrative oversight. 10%. Failing to file electronically when mandated, which, by the way, is typically required for fleets reporting 25 or more vehicles, acts legally as a total failure to file. And that can trigger a massive, uncapped 10% penalty based on the gross amount of the tax liability. But wait, it gets worse. Here is a surprising and highly punitive fact. That penalty accrues monthly, adding an additional 1.5% for each and every month it goes unpaid, exponentially compounding your financial danger. The calculation isn't just based on some minor fee, it's based on the gross amount owed, and believe me, it stacks up incredibly fast. Okay, Section 4, Suspensions versus Total Exemptions. Let's dig into this. This is a critical distinction that separates temporary reprieves from absolute exclusion from the tax ecosystem. You have to know whether your vehicle is merely suspended for the year due to documented low mileage, or if it's completely exempt. If you expect a vehicle to drive 5,000 miles or less on public highways, or 7,500 miles if we're talking agricultural use, the tax is suspended. But here is the major compliance trap. You must proactively report a suspended vehicle to the IRS on Form 2290 to claim that status. In this system, silence is treated as a failure to file, not an exemption. A totally exempt vehicle, on the other hand, like a 100-ton mobile crane or maybe a blood donation bus, simply does not exist within this regulatory framework. It requires zero reporting at all. Bringing us to Section 5, Entity, Identity, and Filing. Let's figure out who is actually responsible here. The data here totally dismantles common assumptions about overarching corporate umbrellas. Experts emphasize that every single business entity must report independently based on its specific employer identification number, or EIN. If you operate 5 distinct operating subsidiaries, you cannot just file one consolidated heavy vehicle tax return for the whole group. Consolidated returns are strictly forbidden. Each entity with a unique EIN must file its own independent Form 2290. Furthermore, the overarching legal owner isn't always the one responsible for the tax. Surprisingly, the liability strictly attaches to the entity legally listed on the vehicle's state registration, often called the tab card, at the exact time of first use on the public highway. All right, our final section, number 6, Proof of Payment Compliance. Let's look at how this highly structured data translates into actual physical highway deployment. It brings up the ultimate operational question. Practically speaking, how do local authorities guarantee this overarching federal mandate is satisfied before they hand over your state license plates? Well, there has to be a physical, verifiable checkpoint, right? The mechanism relies entirely on a stamped Schedule 1. This is a formally watermarked Schedule 1 receipt that is securely returned to you upon successful Form 2290 filing. Local DMV offices basically act as the strict enforcement arm for the federal government here. They will absolutely not issue your registration tags without this specific watermarked document in hand. And this is exactly why electronic filing is structurally prioritized by the system. When you e-file, you receive this stamped Schedule 1 proof within minutes, getting your trucks legally on the road almost instantly. If you stubbornly decide to file by paper, you are looking at a devastating, multi-week wait for that receipt to slowly arrive by mail, keeping your assets parked the whole time. But here is a fantastic, non-obvious, actionable insight based on the expert data that can seriously save your logistics timeline. It's called the 60-day rule, and it provides a critical operational grace period. If you just bought a truck, you can temporarily bypass the certified Schedule 1 requirement at the DMV by simply presenting a valid bill of sale executed within the last 60 days. Elaborating on this cause and effect, the state will register the vehicle immediately based purely on that bill of sale, effectively shifting the burden of federal tax compliance to your back-end timeline. This brilliantly illustrates how the system actually allows for immediate operational deployment while the heavy federal paperwork is being processed in the background. It's a lifesaver if you know how to use it. So I'll leave you with this final, provocative thought to help you evaluate your own fleet operations based on the expert compliance mechanics we've just deconstructed today. Ask yourself, are you accurately tracking fuel weight in your calculations? Are all of your subsidiaries filing independently with their respective EINs? And are you strategically leveraging things like the 60-day rule to keep your supply chain moving without delays? The line between a highly optimized logistics network and a financially devastating compounding penalty often sits quietly right in these Form 290 operational details. Thanks for joining me on this explainer, and I hope this analytical deep dive helps you master the true mechanics of your fleet's liability.